Okay, so the second parameter we've got control of is the open market value. This can be looked at two ways. This could be the asking price. The vendor might be asking for open market value, in which case we might need to be looking for a discount in order to generate instant equity on completion. The importance of the instant equity on completion is that it gives us a kickstart in generating the money, making it available to withdraw in order to pay the deposit on the next property. We are talking about momentum investment here, so we're using growth in the portfolio to finance growth of the portfolio. So that's one way. You've got an asking price equivalent to the open market value. We need to look for a discount. Discounts have sometimes been difficult to find. We tend to discourage investors who are looking for only for properties with discount, because if you look at it, flip it on its head, what you're looking for is a property where you can get an increase in its value. So what we're saying is we need the property to be worth more when we've bought it than it was before we bought it. So the flip side of that could be a rundown property. Open market value in good condition would be 120,000, let's say, but in the condition it's in, it's worth less to us because we've got to take refurbishment into account, in very simple terms. So here, changing the open market value of property has a significant effect on the results. So if we look at our table, we're looking at the moment at the end of year 6 having 6 properties worth just over £1 million, and our portfolio growing at a rate of 34.07% in value to us. So our stake growing at 34.07% average over the 6 years. Now let's say properties buying are slightly higher than that. I mean, a high end for the areas that we look at consistently, it's £160,000. The effect here is obviously it costs you more money to purchase a £160,000 property. You've got less available instantly to grow and generate the deposit for the next property. So the overall effect is, by the end of year 6, we've only got 4 properties in the portfolio, still returning nearly 30%, but obviously the figures look better, like the lower and eminently achievable purchase price of 120,000. Going the other way, there are still properties, even within our area, you can still get a reasonable buy-to-let property for £85,000. Some of these properties may be 3-bedroom terrace, for instance. Others won't meet our strict criteria for minimising risk, which we say you need a 3-bed property for various reasons. And again, that's gone into, we have a set of rules which minimise the risk to the investor, and one of the rules is that a 3-bed property is far easier to let, has a wider appeal to the market, and is likely to attract longer term tenancies than a 2-bed. But having said that, property is still available for £85,000 asking price. The effect on our portfolio now is if you're getting properties at the lower price, then we've managed to achieve 8 by the end of year 6, and we're still making over 30% return on our original capital employed.